All right. So earnings season is upon us. This is Q1 2022, Regions Financial, and they did beat on profit. They lost on revenue. So revenue did not come in as high as expected, and this all has to do with the consumer. And I think that has been basically the focus over the last month or so is the failing consumer. What you see here is just again total revenue 1.6 billion, non-interest expense 933 million. Um, Once you throw the interest expense on top of that, that gets us a net profit of 500 million. So, I mean, hey, 500 million is nothing to sneeze at. But remember, we're always concerned about improvement. We're always concerned about percentages and ratios. How much of their revenue are they able to keep in their pockets versus how much are they having to spend out? First things first, this is the loan book. Okay, so this is basically how many loans they have outstanding that they have sold to customers, that they have sold to businesses. And as we can see, the business loan book has gone up just a bit, but the consumer is coming down. So again, it says everything about a failing consumer. In the earnings call, the or CEO, not sure which one, said that the consumer was healthy, and they talked about the unemployment rate being at roughly 3% in their region of the country. And while that does seem to be somewhat true, I won't say the consumer is dead, right? But the consumer is definitely failing much more than what I think they want to admit. And that doesn't really bode well for them. It really doesn't. They are for sure a consumer bank. I have graphic for this. Here we are. Yeah. So as you can see here, 83% roughly, or no, not 83%, but a large percentage of their pie, right, is made up of consumer customers and just retail, average Joe Blow checking account, right? That's the majority of their customers. They do have quite a few, small businesses and things of that nature. But it's really the person that's going out to work, getting a paycheck and having it direct deposited into their account, and then using that account to pay their bills. And so what happens is, as that person spends less money, then you're going to have less revenue going into the bank. And so that's what's happening right now. They did have a small increase in and I was just looking at it. Yeah, in loans. But again, the consumer declined on those, and so that's across the board. That's going to be on furniture, cars. That's going to be real estate, mortgages, homes, things of that nature. Um, This is something that they were actually shocked about, and that is the amount of money that's still sitting in the account. And this is why it's sort of a weird thing, right? So we know that the consumer is not spending as much money. We know the consumer is maybe not making as much money, but the consumer hasn't taken any money out of the bank. The money that's in that account is still sitting there, and they're still putting the money in there. Now, remember, this report is as of the last 3 months. So we're talking about January, February, and March. So there's possibly going to be a lot of tax refunds that are sitting in those accounts. And Regions Financial expects a lot of that money to come out. Okay. And so as that money comes out, it's going to further reduce revenue. And that's what this is showing here. So the service charges on deposit accounts. Okay. So these are your typical checking accounts, right? And so you can see here um, um, the money from first quarter 2022 is actually higher than it was fourth quarter and first quarter last year. But everything else is down, right? So credit card, ATM fees, capital markets income, which is going to be a lot of those 401ks, IRAs, things of that nature. Mortgage income, right? So again, this is going to be persons going out getting a new mortgage, or this may even be people not paying their mortgage. Commercial credit fee income, again, that's going to be loans that are made to corporations and made to businesses. All those are down, okay? And then the other, which I'm not sure what that is, down almost 9%. Now, Regions did make three purchases on last year. One is Interbank, which is home remodeling, construction loans. Sabal Capital, which has to do with mergers and acquisitions. And then the other is no, I'm sorry. Sabal is mortgages. Yeah, mortgages. And then Clearsight is the mergers and acquisitions. So we know that again, people are buying homes less now because of the rising rates, because of inflation, and so we know that that particular company that they purchased is probably not going to do very well. The Sabal Capital on the remodeling and construction loans. That's an interesting one because typically when you have less new homes being built or less new homes being purchased, you typically have people staying in their old homes longer, and they typically tend to spend more money on repairs and things of that nature. However, we do know that all of the frenzy around refinancing mortgages and stuff like that is over with. Okay, rates are on the rise, and we don't see many people trying to go out and refinance their loans. And so if they're not refinancing, it doesn't make a lot of sense to go out and get a loan to do a home repair, right? A lot of times I think in those situations, unless it's something very drastic, I think you just make do with what you have until the next cycle comes around that you can refinance the home, pull out some equity, and have some cash in your pocket to make those repairs and changes and improvements. The mergers and acquisitions with Clearsight, again, whenever the stock market is down like it is, you're not going to see a lot of companies doing a lot of merging or acquiring of other companies. Sometimes that can happen when the market gets way down because you have companies going out there looking for cheap buys. But right now, that's just not where it is. And so even though I do still think that those were very good additions to kind of diversify their income and add some pocket change, I don't see those three companies making any difference at all in the bottom line at the moment. This is also interesting, net charge-offs. And so charge-offs are those loan accounts that are not going to be paid back. Okay, and so what Regions does is they go through and they try to figure out what is the likelihood that a loan will or will not be paid back, right? And so as they make those decisions, they increase or decrease their provision for losses. Okay, and so what you're looking at in this chart is basically the charge-offs for last quarter. As you can see, back in 2021, this was due to the pandemic. This was January 2021. There was a huge probability that a lot of these businesses were going to go under and that they weren't going to pay their loans. Same thing goes for a lot of the retail consumers out there. And then as we came out of the pandemic, fourth quarter 2021, they dropped that provision way down. And as you can see here in first quarter 2022, they've actually increased it a little bit. And so I expect that to continue to increase because, again, we know that the consumer is failing. There's just no question about it. And at some point, we will start to see persons really not paying their bills and not paying off their loans. One quick thing that I wanted to discuss, I usually poo-poo ESG. I don't think I don't like companies spending a lot of money on it other than maybe, something like an oil company or something like that that's directly related to the environment. But this one was okay, right? They did talk about their carbon emissions, which to me is ridiculous. I don't know why they're spending money to reduce carbon emissions. I mean, it's a bank, right? Maybe the AC blows too cold or something. I don't know. But they did talk about diversity. They did talk about the transparency around salaries, and I think that's good. Again, don't want them to spend a whole lot of time or money on this kind of stuff, but I do think it's good that they're sort of getting ahead of any issues that can potentially come down the pipeline, right? With workforce issues that we see so common nowadays with companies getting sued for discrimination and whatnot. So not horrible. The other thing I wanted to talk about, which was really funny on the call, was so Regions Bank, like many banks, they go out and they purchase securities no different than you or I. And so they decided that they were not going to purchase as many this quarter. They're pretty much staying out of the market until some things turn around, which makes me feel really good about staying out of the consumer sector for the moment. But they did put some money to work, and so they have lost money on that money. And when asked about this, the CFO, CEO became very defensive and basically said, don't look at that number. It doesn't make sense to look at that number because the market is up and down. What's down today can be up tomorrow. And he actually said in one response, if you want to try to look at those numbers and determine, what our stock portfolio is doing on any given day, good luck, is what he said. Personally, I do always include those numbers. I think it's important. I think it's a sign of the management of the company. And, your decision on what to do with your cash and when to deploy it is important. And so that is something also to take into account, is that they are involved in the market. The market is down, and so that's going to also decrease the balance sheet value. And as we all know, banks particularly are very close to book value, always. If the stock price or price to book is above that one ratio, then typically we call them expensive. When they're below a one ratio, then we say that they are cheap. And so if in fact we look at this valuation and determine that the book value is much less than one, then I will be very excited about purchasing this bank, because for a bank, their assets are pretty much cash. So the CFO, CEO said that in his opinion, when looking at a bank's balance sheet and looking at their security purchases and things of that nature, it's always best to just do it at a fair value. Meaning that if they purchase something for 1.5 billion, go ahead and just evaluate it at 1.5 billion. Don't try to overvalue or undervalue it. Personally, I think it's a good idea to evaluate it based on whatever that mark to market is. So whatever their price is when they report earnings, that's what we're going with. Even if the stock price, shot up a month after that, I think it's important, again, just from a management perspective, to see really how the cash is being managed. And if the next quarter the stock market comes back, right, and they make a lot of money, and we see that reflected on the balance sheet, well, that's great. We'll see that improvement. And then over time, we'll be able to put together 3, 4, 5 years and say, okay, well, we can see that you have managed this money well over this time period, or we could say that you've lost money consistently in the market over this time period. And so definitely something I'm looking forward to looking at. The other thing I want to mention is they got out of their, and I had a graphic for this, and I don't see it now, but they got out of their interest rate swaps. They were invested in some interest rate swaps when rates were low, and the purpose for that is banks make money when rates are high because they're able to charge more money for their loans. And so when rates are low, they typically will purchase these hedging securities that will actually pay them money when rates move down, right? Now that we're in a rising rate environment, they've pretty much closed all of those securities. swaps and whatnot, and they're starting to purchase new ones, but they're doing it little by little, right? They haven't just gone all the way into it yet, but they are starting to add new forward rates, meaning that as rates rise, they'll actually get paid from those hedging securities. So again, not well. I'll say decent quarter, right? I mean, a lot of stuff is just out of their control. It's nothing they can do about the economy. You know, it is what it is. But I think the fact that they beat on profit expectations says something to the management of the company. It says something to the benefit of adding those three businesses that we discussed earlier. And I really do look forward to evaluating this company and really seeing where it's at and deciding whether or not we purchase more shares.